Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 20th of July. I'm Daniel Lam, your host for the podcast. In the client events that I was presenting at last week, the key overwhelming questions were: what to do with the semiconductor stocks? Is there going to be further downside? What should we be investing in? Well, to the loyal listeners to this podcast, I'm referring specifically to the podcast on the 1st and the 9th of July. You would know that I've been advocating the rotation from the exuberant sectors into the areas of non-exuberance for the quiet summer months, such as US healthcare, US financials, and globally into European equities, and last but certainly not the least, Chinese equities. I'm reciting what I said in the podcast on the 9th of July. Open quote. And some stabilization we've had. The Hang Seng Index has been recovering well since it hit the year low around 22,500. Is there further room for more upside in the Hang Seng Index? Question mark. Close quote. Well, certainly the Hang Seng Index has been recovering very well indeed. The factors that I mentioned in the previous two podcasts are certainly providing tailwind. Fund rotation, as well as the falling demand for US dollar. The most recent developments are providing good support for the case of further drop in the US dollar, which can lead to more rotation into Hong Kong China equities. I'm referring to the softer CPI, as well as the inability to significantly re-escalate the tensions in the Middle East from Trump, when he announced 20% levy on Hamas ships, but then backing off after. Hence, we see further upside to the Hang Seng Index. It's still trading at a significantly cheaper valuation than global equities. Now granted, the nature of the companies in the index, particularly the technology stocks there, which are primarily internet related, are very different from the AI high technology companies from quote-unquote the other camp, i.e. the US, Korea, Taiwan, and Japan. But fund rotation is a major factor, and the price action from the tech majors from this other camp, when they made decent earnings announcements but still suffered from sell-off after, shows that this fund rotation has more room to go. It is reasonable to assume that the Hang Seng Index would be hovering around the 25,000 level in the very near term, because that is a significant technical level for the index, and it is probably going to be consolidating around there before testing the upside further, looking at key levels such as 26,000 and perhaps 27,000. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.